Guys, now we shall be starting with chapter number 4, which is on audit evidence. And if you can see the list, we have a lot of standards here to cover. We have a lot of concepts here to cover, and we'll be primarily, the discussion will revolve around the 500 series of the standard, which is on audit evidence. Okay. Now, to begin with, we shall first be covering the standard, which is yeah, which is SA 500. Okay. And in 500, 500 is the fundamental standard, guys, of audit evidence. So what all things do we have to cover? We shall learn as to what is the meaning of audit evidence, what would amount to sufficient and appropriate audit evidence. It's one of the basic standards. Now in my regular lectures, I take it very early in the initial classes of the audit. I mean, I start with 200, 210, 230, and the next standard that I take is 500, because this is a very fundamental standard. In this standard, we primarily learn as to what different procedures an auditor can apply ultimately to obtain sufficient and appropriate audit evidence. Okay. But because it's a revision session, doesn't matter, I mean, much on the sequence. I'm assuming that you have the basic knowledge. So let us quickly start, guys, with SA 500, which is on audit evidence. So what is the meaning of the word or evidence? It is basically the information which is used by the auditor in arriving at the conclusions on which the auditor's opinion is ultimately going to be based on. So all of you know this, guys, that when we actually do the audit, we apply procedures. Upon application of audit procedures, what we get is called as audit evidence, and on the basis of these evidence, we ultimately form a conclusion and express our opinion, right? So what is audit evidence? It is information used by the auditor in ultimately arriving at the conclusion, right? Now whenever you apply audit procedures, guys, the type of evidence we have to obtain has to be sufficient and appropriate. So what is meant by sufficiency? Sufficiency means quantity, that you have to have the right amount of, let's say, audit evidence. Okay. And it's not just about only the amount, guys, it is also about the quality of audit evidence. Okay. So we have to have appropriate audit evidence as well. Now when I talk about appropriateness, it means quality. And to be more specific, what is meant by quality? It means your audit evidence should be relevant and it should be reliable. Okay. So we have two concepts here with respect to appropriateness that you have to keep in mind. What are the two concepts? Two concepts are relevance and reliability. I'm going to take up the reliability first, and then we shall come up with the concept of relevance. We shall discuss the concept of relevance. Now, guys, we obtain audit evidence, right? So we have to obtain reliable audit evidence. Now very simply, if I put, guys, you might not be very much happy with photocopies. If the management gives you photocopies rather than showing originals, you will not be very happy, right? And you would be more you would rely more on that evidence which is generated outside the entity, that means which is externally generated, rather than the one which is generated by management and given to you. Now for example, if I tell you this, that let's say I'm looking at the sales of a company, of the company, and the company is showing me sales invoice. Yeah, it's a valid document, but more than that, probably if something you see which has been externally generated, let's say the party who has purchased the goods, they have given us a purchase order, so that is going to be more reliable. So we are going to learn certain rules, okay, about reliability. So, and all of you know this, that the reliability is influenced by the source, and also whether it is given to you orally or verbally. If management tells you something verbally but they are not keen on giving to you in writing, that means it's not going to be a reliable thing. So you should always trust the written documents more, right? So we are going to learn about certain rules of reliability. There are 5 rules that you have to keep in mind. Very simple, guys, that external evidences are going to be more generally more reliable than internal evidences. I'm not saying that internal evidences are not reliable, but then in organizations where the internal controls are really good, you would, of course, have reliability on, you would place reliance rather on the internal information as well. So the second point says, if internal controls are effective, the internal evidence's reliability increases. Okay. Now, third rule is basically the evidence, guys, that you have obtained directly will be more evidence as compared to some evidence which has been given to you by the management. So if you obtain evidence that which is directly obtained by you, by the auditor, it is going to be more reliable. Documentary evidence, written in evidence, is going to be more reliable as compared to oral evidence, and originals would always be more reliable than photocopies, right? So remember these 5 rules with respect to reliability. Done. Now, what is the meaning of the word relevance? Guys, relevance in simple words means that you are going to apply, you want to obtain those evidence which is relevant for the assertion that you are wanting to test. Now, for example, if I talk about land and building, okay, and you want to see the valuation of the land and building, so and they are showing you property papers. So probably property papers would establish ownership, but then what is the value of the building? Okay, it might not be a relevant procedure, right? I mean, if you do a physical verification, for example, physical verification would establish that the building exists, right? But then it is not going to give you an idea about the valuation part. So for valuation, maybe we need to check, yes, the property papers, the stamp duty and all the consideration may be mentioned there, or current value if you are taking, okay, fair value, etc. You might have to obtain the valuer certificate, right? So what is relevance? Relevance simply means the test, the kind of assertion you are testing, your procedures has to be accordingly done. So what is relevance, guys? It implies whether the evidence successfully tests the assertions which is required to be tested. So if you want to test existence, okay, seeing this valuation certificate will not give you evidence. If you want to see existence, you will have to go for physical verification, right? So relevance means doing the right audit procedure for the assertion that you want to take. There has to be a logical connection between the procedures that you apply and the assertion that you are testing. Okay, so this is called as relevance. So when we apply audit procedures and when we obtain evidence, the evidence has to be both sufficient and appropriate. Appropriate means, guys, relevance and reliability. It has to be relevant. Okay, now if I obtain, let's say, I obtained a valuation certificate and then I'm saying, yeah, the building exists. So that's not a relevant audit evidence here. Okay. All right. So yes, we are done, guys, with the concept of sufficient and appropriateness also. Okay. Now, this chapter, the name is audit evidence. Okay. And you also have to understand that there could be different sources of evidence. Evidence can be classified on the basis of sources, okay, like internally generated, externally generated. It can be on the basis of nature also, whether it is a documentary evidence or whether it is an oral evidence, or whether you get evidence by observing things. Okay, so there can be different types of evidence. But now this chapter, guys, though it is about audit evidence, but then this chapter is going to teach us as to how to obtain audit evidence. So we are going to learn about different audit procedures. Okay, so if you can see the next topic, it says audit procedure for obtaining audit evidence. So all of you know this, that there are two audit procedures. Okay, we have been covering all these standards. We have already covered 315, 330, but yeah, this is something which is basic again now for you. So we have two procedures, RAP and we have further audit procedures. Okay, now when I say RAP, what is RAP? These are designed to obtain an understanding of the client and its environment, including internal controls, to assess risk of material misstatement. Entire RAP, entire risk assessment process, guys, we cover as a part of SA 315. And once you assess your ROMMS, what we have to do basically, how do we respond to that assess risk of ROMMS? We are going to do the further audit procedures. And further audit procedures is basically we learned about it as a part of SA 330. Okay, so further audit procedures, all of you know, consist of test of controls and substantive procedures. Test of controls basically are designed to test the operating effectiveness of controls, whether the controls are operating effectively, whether the controls are in continuous operations or not. And when I say substantive procedures, guys, always remember, substantive procedures test the accounting data. So if you want to find misstatements, you will have to perform substantive procedures. Test of controls is only going to give you an idea about the controls, whether they are operating effectively or not. Testing of controls would help you to find deviations from the prescribed control. When the control is not functioning as intended, these are deviations. On the other hand, substantive procedures is going to help you to find misstatements. So they are performed to check completeness, accuracy, and validity. Remember, three things: VAC. They are used to check completeness, accuracy, and validity of transactions and balances, and it includes substantive procedure, includes test of details as well as analytical procedures. And we covered this in 330 also, that test of details can further be classified into vouching and verification. So all these are very basic now for you. Okay, all right. So yes, these are the audit procedures. Now a good question that might be asked from this part of the chapter is, what are the methods, guys, to obtain audit evidence? Okay, so we cover these procedures, but ultimately these procedures are broader words. But what exactly the auditor is actually going to do to obtain evidence? So we call them as methods. Okay, so whether you're doing RAP or FAP, I mean, you probably must be knowing now. In RAP, I told you what is it that we do in RAP. Sir, we do mostly inquiry, then there would be some analytical procedures also, then there can be inspection observation. This is what we do in RAP, right? We covered this as a part of 315 also. Okay, but so these are all methods only, right? These are methods. When you do an inquiry, it's a method of obtaining audit evidence. When you do a uh, inspection, it's a method of obtaining audit evidence. So what are the methods? We have got 7 methods of obtaining audit evidence, guys. Very easy topic. Number one is inspection. Second is observation. Now, what is inspection? Inspection generally is when you inspect certain documents, or maybe you might inspect something which is tangible in nature. uh, Documents, when you see the documents, let's say I'm seeing the purchase order, it's a inspection. Okay, observation is more about seeing the processes, understanding the processes. Okay, external confirmation, guys, we have a standard on this SA 505. It's basically obtaining confirmation from third parties. It may be debtors, creditors, bankers, etc. Now, let's say the company has calculated the depreciation or interest figures. You can just simply redo it, recalculate it as per your understanding, and you can match. If the things match, that means the depreciation value is correct. This is called as recalculation. Analytical procedure, again, we have a standard on this, which is SA 520. Analytical procedure is basically the intelligent auditing that we do, wherein we calculate the ratios, we compare the ratios of the current year with that of the previous year. It can include comparisons, it could include relationships, etc. Okay, and re-performance is doing something which management has already done. Let's say management says that, yeah, sir, we did a physical verification of inventory yesterday only, but you would want to do it again, so it's a re-performance. An inquiry, of course, you can make inquiries of persons who have the knowledge. I told you this inquiry can be made with anyone in the client's company. It is not just restricted to the accounting team or finance team. You can go and inquire from any employee of the company, even outsiders. Okay, so these are 7 methods, guys, of obtaining audit evidence. Okay, now almost end. Yes, we are towards the end of the standard, guys. Now, one very important topic as a part of SS 500 is using the work of management expert. We have a topic, using the work of management expert. Okay, now before I start with this concept, I just want to discuss quickly as to what is the concept of management expert. Okay, so I'm just opening the regular notes. Probably yeah, you'll find it here. So before, the topic is using the work of management's expert. So first, let us understand that, guys, the concept of expert. Okay, in the entire auditing subject, we'll be discussing about two experts. One is management's expert, and the second one is auditor's expert. Okay, now who is a management expert? Let's first understand this. It says an individual or an organization possessing expertise in a field other than accounting or auditing. So it's a person or an organization who has some expertise, but that expertise has to be in a field other than accounting or auditing. Because accounting and auditing, guys, chartered accountants are expert. Okay, so this management expert should be a person who is an let's say an individual or an organization who possesses expertise in a field other than accounting or auditing. And why would management use this expert? His work is actually used by the company, by the entity, in preparing the financial statements. So management must have used the work of management's expert in the preparation of financial statement. Now, for example, let's say the client is they are an insurance company, and they don't know how much provision to make. They don't know about the claims that may come this year, and accordingly how much provision and all to be made. So they take the services of a actuary. Is an expert who has knowledge of of he has immense knowledge of all the statistics and mathematical calculation, probability and all he'll use, and then he might determine the amount of, let's say, provision for claims. Okay, so management has used that expert for the preparation of financial statement. Okay, now if there is a case of management expert, probably now the question is, as an auditor, you are the auditor of financial statements, right? So will you directly accept the provision of claims figure which the management expert has given in the financial statements? So this is what we have to learn. What will be our duty here? What will be our responsibility? Are we blindly going to believe what the management expert has given in the value of provision for claims, or should we do our own procedures? So we are going to learn about it. But meanwhile, before I start that, remember guys, when I talk about expert, we have someone called as auditor's expert also in our subject of auditing. And who is an auditor's expert? Auditor's expert, again, almost the same definition. He is an individual or an organization possessing expertise in a field other than accounting or auditing, but his work is used by the auditor. So he's my expert. He's going to be, let's say, a part of my team only, and I'm going to use his work to obtain sufficient and appropriate audit evidence. Now, if the case is of auditor's expert, it will be dealt in SS 620. Now, let's say my client, okay, he has a jewelry business and he deals only in very expensive diamonds. So I don't know how to see the valuation of diamonds, and also I might need the help of an expert there. So the expert is going to help me to obtain sufficient and appropriate audit evidence. Okay, so 500 guys, in 500 we are going to talk about management's experts only. Okay, now what is the context? Again, let me tell you, management has made the financial statements, right? And let's say provision for claims is there. Now management tells me, sir, what are you going to check here? This has been anyways, the provision amount has been given to us by the actuary, so it is going to be correct only. But then the question is, as an auditor, as the auditor of the financial statements of this company, will you blindly trust or rely on the management's expert work? No, we have certain duties here. So what are the duties, guys? We have got three duties, if you can see. Yes, we have to first evaluate the CCO capability, competence, and uh, 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 objectivity of that expert. You have to evaluate whether the expert is competent, he has the capability, and you also have to evaluate the objectivity. What if this expert, this actually is happens to be a relative of the director? So then in that case you might not be able to trust on his work much. So you have to see these three things: capability, competency, and objectivity. Then you can't just blindly trust his work, but then you have to obtain, see, you are a chartered accountant, at least if he tries and explain it to you, you will have some basic understanding, right? So you have to obtain an understanding of the work of that expert. And after having understood the work of that expert, you have to see whether his work is appropriate or not. Evaluate appropriateness of uh, experts work. And now how are you going to evaluate whether the work performed by the expert is appropriate or not? So you have to, there are certain considerations. What are the 3 points again, guys? Number one, you have to see whether you have to check upon the reasonableness of experts findings. Okay, and you have to see whether it is consistent with the other evidences that you have obtained. Again, you have to see the reasonableness of the assumptions. So number one is reasonableness of his findings, and you have to see the consistency. Second is, if you have used any assumptions, you have to see whether those assumptions are reasonable or not. And then again, third is, you have to see the reliability, the accuracy, the completeness of the source data, if at all it has been used by expert. Let's say expert is using some basic data, some source data, so you'll have to see whether that source data is reliable or not, else all the calculations would be wrong. Okay, so guys, you can't directly just use the work or rely on the management experts work. Basically we have certain duties. So first three things, what are the three things? Number one, you have to see the capabilities, competency, and objectivity of the expert. Second, you have to obtain understanding of his work and see his work is appropriate or not. And how will we see whether the work is appropriate or not, guys? Three things. You have to check upon the reasonableness of his findings, check upon the reasonableness of the assumptions that he has used, and see whether the source data used by the management's expert is relevant, complete, accurate, or not. That's it. And with this, SA 500 is over. We have covered almost all the concepts, important concepts from SA 500. Okay, all right. Now, going back to the master chart, guys. So I told you this chapter number 4 is a big chapter, right? So we have just covered one part of it, which is SA 500. Now, again, we are going to start with SA 501, which is also, if you can see the name is again audit evidence. Okay, but here we have to learn about specific considerations. We are going to learn about some aspects for some selected items, specific considerations for selected items. Now we have only 3 items in this particular standard, guys. If you can see in the chart, we have inventory, we have litigation and claims, and then we have segment reporting. So this standard is going to teach us, sir, is this standard going to teach us how to obtain evidence with respect to inventory? Yes, but remember, guys, this standard is not going to teach us all the procedures that we have to apply for inventory. It is only giving, is going to teach us some specific considerations. That means, sir, in this standard, with respect to inventory, we are only going to learn procedures with respect to testing the existence and condition of inventory. Okay, now with respect to litigation and claims, we'll see whether they have been properly identified and recognized in the books or not. Litigation and claims. Segment reporting, will see basically litigation and claims, we are concerned with the completeness of litigation and claims. Segment reporting, we are concerned whether presentation and disclosure of segment information has been properly done or not. So please keep in mind that, okay, yes, we are learning about inventory here, but we are not learning all the audit procedures of inventory. We are only learning audit procedures with respect to existence and condition of inventory. How do you check upon the existence? And that is why the procedures will revolve mostly around physical verification. Okay. Now, that is why the name is specific considerations for selected items. Okay, let's begin, guys. Let's start with the inventory. So what is the auditor's duty with respect to inventory? What is the auditor's duty? Very simple, guys. He has to obtain, in this standard, our duty is basically to obtain sufficient and appropriate audit evidence regarding existence and condition of inventory, whether the inventory exists or not, and if it at all exists, what's the condition of the inventory? Is it sellable, or is it damaged? Or let's say if it is a medical pharmaceutical company, whether the goods are expired, because if the goods are expired, it can't be sold, right? So we are going to see the existence and condition of inventory. If some of the medicines are damaged, pharmaceutical company, we have all those injections in vials which comes in the small glass bottle, so a lot of time there is damage. So as an auditor, using this standard, I'm only concerned with respect to the existence and condition of inventory, right? So what are the procedures? What is your duty? What are the general audit procedures? Very simple, guys. It says you have to attend the physical inventory counting if it is practicable. So see, physical inventory is the responsibility. Doing the physical verification is the responsibility of the management, but as an auditor, we have to be present there. So unless it is impracticable, you have to attend the physical inventory counting, guys. Okay. And when you attend the physical inventory counting, what is it that you are going to do? You're going to do the four things. Number one, you're going to see and understand management's instruction and procedures. You're going to observe the test count procedures which the employees of the management would be doing. And on random basis, you would also inspect the inventory and do your test counts. Let's say there are certain carton boxes. You would want them to open the carton boxes and count what is inside, how many bottles are inside, or the strips of medicines are inside. So you would also want to do some test counts. Okay, so when you attend the physical inventory counting, it's not that you're going to have fun and have tea and coffee there. No, you have to follow these things. I mean, you have to understand management's instruction and procedures. You have to observe, if they are counting, you have to observe the test count procedures. At times you have to inspect the inventory and do the test counting by yourself, perform some test counts. Okay, and guys, what happens, we are talking about the physical verification. So management would generally give you a stock statement which is generated from the system. They will give you a list, sir, as per our system, as per our accounting software, as per our inventory module, inventory software, these are the inventory items we have and these are the quantity. And then when we do a physical verification, we do the matching. Oh, this medicine, they say in the books it's 100 quantities, actually how much is there? So we are going to count, oh, it's 100, then we put a tick mark, right? So ultimately, what is it that we do? We perform audit procedures over final inventory records. So that means we match it, okay, to the stock statement. Anyways, this was very simple. But then, guys, we have certain procedures to apply in special circumstances. I told you one basic rule, that yes, you have to attend physical verification and you have to do all these things. But let's understand some special circumstances also. We have got four different special circumstances, guys. Number one is, generally, see, you are the financial statement auditor. You would be concerned about inventory as on 31st March, right? So now, guys, let's say if the inventory that they are checking, it says that if the inventory count date differs from the financial statement date, let's say they say that they are doing it on 5th of April, then what is it that we have to do? Then it says additional audit procedures you have to do to ensure changes are properly recorded. I mean, you might have to do the additional audit procedures. Okay, from 1st of April till 5th of April, they might have certain transactions also, they might have made certain purchases, sales, so you'll have to reconcile and go back to the inventory of 31st March and accordingly do the physical verification. Okay, if let's say guys you were unable to attend physical count due to unforeseen circumstances. When I say unforeseen circumstances, that means let's say they had planned it for 31st March only, or let's say 5th April, and you were supposed to attend the same, but then there was a death in your family, and or maybe you were unwell or something happened because of which, or COVID happened, let's say lockdown. So because of which you are unable to attend the physical verification on that particular date. In this case, what is going to happen? So you will have to conduct the physical count on an alternative date. And let's say now you were not able to attend it on 31st March. So let's say you do it on 8th of April, and for these 7-8 days in between, which has passed, you will have to audit the intervening transaction. That means you'll have to reconcile, you'll have to check on the sales, purchases, etc. Okay. All right. Now, guys, if you see the next special circumstance, it says if it is impracticable to attend physical inventory count. So there is a difference. I mean, here in point number two, in the special circumstance number two, you couldn't attend due to unforeseen circumstances. But in circumstance number three, it's impracticable only. I mean, let's say my client has an oil rig, so you can't jump into the oil rig and see how the inventory is, right? Or let's say they have an iron ore factory and all, and you want to see the work in progress, how much is the quantity, how, what is the WIP basically, but then the temperature inside the entire let's say system is 5,000 degrees, 3,000 degrees. It's not possible for you to go inside, right? So in that case, what has to be done? So if it is impracticable to attend physical inventory location, then perform alternative audit procedures. So if I am not able to do it, maybe I can hire some expert, or I'll have to expert as in one who has the tools and equipment to understand what is the inventory in the oil rig, let's say. Okay. And again guys, if even after, you should basically try and perform alternative audit procedures, but even after applying alternative audit procedures, you were unable to find sufficient and appropriate audit evidence, you were unable to obtain sufficient and appropriate audit evidence, then in that case you might have to modify your opinion in accordance with SS 705. Okay. Then sometimes it may so happen that the inventory is coming in the books, but physically it is not in the store, it is not in the godown, it is lying somewhere else. It might be at a place in a third party's place. Sir, why will this happen? Maybe you have sent the goods on sale or approval basis. Maybe sometimes the goods that have arrived, I mean, it was goods in transit, it is in our inventory only, but it is still lying with the transporter. Okay, so this might be the case. So in this case, what has to be done now? In the stock statement which the company gave you, the stock is appearing, but physically it is not there. So what has to be done here? So if the inventory is lying in the third party's custody, you have to obtain sufficient evidence by either requesting a confirmation. You can go for an external confirmation with that third party. You may ask the transporter or ask the consignee to whom the goods have been sent on sale or approval basis, uh, uh, yeah, about the quantity, about the condition of inventory. And sometimes the transporter and all, let's say if they happen to be in your same state or same city, they are locally, they might even ask you to, hey sir, we don't have any so much time to give you all the details, it is better you only come to our place and do the physical verification, we don't mind it. It's good for the auditor, right? So perform inspection or other appropriate audit procedure. If they allow, we can go and do the physical verification there. Okay. So with this, guys, if you can see the first part of the chapter, I mean the topic SA 501 is over, and we have covered the procedures with respect to existence and condition of inventory. Okay. Now let's talk about litigation and claims. What is it that we are going to learn here? We are going to learn about audit procedures which ensures completeness of litigation and claims. Now what happens in many companies, many types of companies, specifically let's say if it is an FMCG and all, so some or the other sort of cases and all keep on happening against the company. Probably not, the company might even get to know about it a month later. Somewhere in the court of, let's say, some village in Haryana, somebody ate the consume the let's say the product, and he is unwell or something like this may happen, he's filed a case against the company in the court, in the district court, let's say, or in the lower courts in let's say Haryana. Okay. And then till the time you get to know about it, I mean, it might be, there might be some gap also. And let's say my client is into transportation business. Okay. And they have a lot of trucks, they have around 500 trucks and a lot of drivers, and many a time this is a part and parcel of the business, that many times the driver will drink and then they will drive, and they'll, there's some issue now and the driver has fled away, and of course the case has been registered against the company because the company owns the vehicle. So all these things keep on happening, right? But then as an auditor, I have to be concerned whether with respect to the completeness of litigation and claims, because sometimes what happens, let's say if there's a case against us and we know we are about to lose the case, so we have to make the necessary provisions. You just can't show it as a part of contingent liability. Necessary provisions and all has to be made, right? So let's talk about litigation and claims. Number one is identification of litigation and claims. You first as an auditor have to see whether all litigation and claims have been identified. And how can you do that? Number one, you have to make an inquiry of the management and other relevant personnel within the entity. So it may be TCWG, it may be the in-house legal counsel, etc. So you have to make an inquiry. You may in fact review the minutes of the board meetings also, because if there is a major case against the company, they must have definitely discussed about it in the board meeting. So when you go through the minutes of the board meeting, it is going to give you an idea as to about the case. Okay, and you can even check the legal expense account. If there is a big case against the company would have paid retainership fees, the company would have paid professional legal fees, right, to the advocates, to the external legal counsel. So by going through the P&L, by going through the legal expense account, you would have an idea that, oh, there is a case. So for identification, guys, we have three procedures. Number one, you can make an inquiry of the management, you can review the minutes of the meetings, and you can also check the legal expense account. Then we have what is the additional procedures that we can do. Okay, now guys, see, if you want to obtain information about a particular case, okay, as to what is the status of the case, we may seek direct communication with the legal counsel, legal external legal counsel, if the risk of material misstatement is assessed or if other material litigation or claims may exist. So we can, number one is you may seek direct communication with the external legal counsel, and for this you are going to send a letter of inquiry. We are going to send a letter of inquiry to the external legal counsel. Okay, but if let's say this is prohibited, we might have to perform some alternative audit procedures. Okay, now we may send a letter of inquiry. A letter of inquiry can be a general letter of inquiry, it can be a specific letter of inquiry. However, guys, sometimes what happens, that advocate would not be willing to reply or respond, because for us, for the advocate, we are a third party and he might be bound by his own code of ethics. Okay, so he might not be wanting to share the details of the case with a third party. I'm the auditor, for him I'm a third party, right? So if it says if response is unlikely, probably, okay, we can send a specific inquiry letter with detailed information. Okay, but then it is not always necessary that the external legal counsel is going to reply. If it is prohibited, guys, we have to perform alternative audit procedures. Okay, now you may also consider meeting external legal counsels if it is a very significant risk. If you are not agreeing with the management, you might also meet the external legal counsel. But then remember, guys, this direct communication, this meeting with the external legal counsel, this sending the letter of inquiry to the external legal counsel, this is not going to happen discreetly, that management should not know about it. No, we are going to do this with the consent of the management, with the permission of the management. In fact, it will be routed through the management. But then when the external legal counsel replies, it has to be a direct reply to the audit. Okay, now guys, modification, even after you do all these things, okay, you might have to sometimes modify the opinion when let's say management refuses permission for communication. Management tells you, no, 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 we won't let you communicate with the external legal counsel, or will not let you meet with them. Okay, or external legal counsel doesn't respond, external counsel refuses to respond appropriately, or he is prohibited from responding. I told you he might be prohibited because of his own code of ethics. Okay, or auditor, he tried to perform alternative audit procedures, but even then he is unable to obtain sufficient and appropriate audit evidence. In this cases, you might have to modify your opinion because you have not been able to obtain sufficient and appropriate audit evidence. Okay, so done. These are the procedures, guys, with respect to the litigation and claims. Again, let me tell you, the entire procedure revolves around completeness of litigation and claims. Okay, and the last part, guys, is very simple. We have a topic with respect to segment reporting. Okay, when I say segment reporting means, sometimes for some companies they will have to, let's say they deal into four products. Okay, so when I see the P&L, let's say the turnover, the sales, the revenue from operations, when I see the P&L, it is only going to be a consolidated figure of the sales of all the four products, right? But then for certain companies, when AS17 segment reporting is applicable, they might want to show the different say the sales of the different products A, B, C, and D. So this is basically segment information. Now segment can be product wise, it can be region wise. I mean, let's say we can disclose the data through the four divisions: north, east, west, south. It can be anything. So when I talk about segment reporting, the number one thing which we as auditors are going to be concerned about is the understanding the management's method, okay, of how they have shown the segments or segment information. So obtain an understanding of how management determines the segment information, okay. And we have a point here. So what are the factors to consider when understanding management's methods? Okay, so first is we have to understand their method, but what are the factors that you are going to consider to understand the management's method and assessing whether compliance has been did? So the methods which the management may use can be anything, guys. It can be, let's say, uh, how they record the sales, the charges, let's say between the departments if they have divisions, okay. So have they eliminate how they eliminate the inter-segment departmental amounts and all, okay. And then comparison with the budgets and expected results, allocation of assets and cost among segments, and then consistency with prior periods and adequacy of disclosures regarding inconsistency, whether there is consistency with the prior periods or not. So you have to obtain an understanding of management's how management determines the segment information, and these are the things which you have to take into consideration, okay. What are the things again, with respect to, let's say, sales, transfers, charges between the segments, whether there is elimination of profit and all or not. You can see whether the methods they have used, whether the information, you can compare it with the budgets and the expected results. Then consistency also with the prior period information, whether there is consistency or not, okay. Then we have to see, the only thing that we have to see, I mean, this standard only tells us that as auditors, this standard tells us that we have to see whether the presentation and disclosure of the segment information is as per the applicable FRF or not. Let's say AS17 in your case, okay. So evaluation of disclosure, evaluate whether segment disclosure complies with the applicable financial reporting framework, okay. Now understand, guys, even though one very important thing I would want you to understand is, even though the segment information is given, when we express our opinion, it is not on one segment. We express our opinion on the entire financial statement, right? So just one thing you have to understand is auditor's responsibilities in relation to the financial statement as a whole, okay. We are not required to perform procedures for expressing opinion on segment information on a standalone basis. We are not expressing opinion on the segment information individually. Let's say there are four products, so we are not expressing four opinions. We are giving opinion on the entire financial statement as a whole, but we just have to see whether the compliance with AS17 they have done or not, okay. Yes, with this we have covered SF501 as well, okay. All right, so these are kind of small standards, okay, and easy ones also. So if I go back to the master chart, guys, we have completed 500 and we have completed 501 also, okay. Now moving on to the next standard from the 500 series, we have SF505, which is on external confirmation. Now let me just tell you before I start this standard, SF505, guys, external confirmation. External confirmation happens to be one of the methods of obtaining audit evidence. In 500, I taught you 7 methods, right? If you remember, inspection, inquiry, observation, recalculation, reperformance. Then we had analytical procedure and external confirmation. So for external confirmation, we have SF505. For analytical procedures, we have another standard SF520, okay. So let us quickly understand external confirmation. What is meant by external confirmation? We have these things to cover. It's a very, again, a very easy standard, guys. So what is the definition external confirmation? Let's understand certain definitions first. What is external confirmation, guys? External confirmation is audit evidence obtained, please be very careful here, audit evidence obtained as a direct written response to the auditor from a third party or a confirming party in paper form or by electronic or other medium. So let's say, guys, I am the auditor of your company and your company has taken a loan from the bank. I want to confirm the outstanding amount, okay, from the bank. So I write to the bank, and they respond directly to me that this is the balance, this is the outstanding balance, then I'll match it with your ledger and see whether everything is okay or not. So this is an external confirmation. Now what has happened here is, when the confirming party replies, it has to come directly to the auditor. I mean, I am not going to ask or send a confirmation request secretly. I'll, with the consent of the management, I'm going to send, but then when the confirming party replies, it has to be directly to the auditor. So it may be in the form of a hard copy, or it may be in the email also. So audit evidence obtained as a direct written response to the auditor, from whom? A third party. Now what could be the examples, guys? In what cases do we go for external confirmation? So getting, if you want to have an idea about the debtor balance, it could be with respect to the creditor balance. You can, if my client has made a lot of investments, I can take an external confirmation from the broker through which the investments were made. I can go for external confirmation from the bank. So this external confirmation method can be used in a lot of situations. Okay, all right. Now, first, guys, I would want to discuss the external confirmation procedure, and then I'm going to come back to the definitions that we have left here, positive confirmation, etc. But what is the external confirmation procedure? Now, number one thing is, guys, we have to determine the information to be confirmed or requested. Oh, okay, I want to know the balance, outstanding balance of this particular data. That's it. So you have to first finalize what data, what information has to be confirmed or requested. Okay, and then you have to select the appropriate confirming party. You have to select the appropriate confirming party. Of course, if I want to know about the debtor balance, balance of a debtor A, I will have to select the party. Yes, I need to send confirmation request, let's say, to debtor A. Okay, then we are going to design the confirmation request, and then we are going to send it. Okay, so very simple process. Number one is what? That you need to confirm first as to what information you want information about. I mean, what information you want to confirm. Number one. Second, you have to select the party. Third is you have to send them the request, and then you have to probably third is basically you have to design the request, and fourth is you have to send them. And if they don't reply, probably you'll have to do a follow up request also. Now, if you see this point, design the confirmation request. Now, designing the confirmation request, we as auditors will design the confirmation request. Now confirmation request can be of two types. Primarily two types of confirmation requests are there. Now I'm going to take you back to the uh, definitions part. If you can see, we have two confirmations here. One is positive confirmation request, and the second one is negative confirmation request. So you have to decide whether which confirmation request you want to send to the confirming party, right? So we'll learn about both positive confirmation request and negative confirmation request. So what is positive confirmation request? Now positive confirmation request asks the third party to reply to the auditor in all cases. So let's say I wrote a confirmation request to one of the debtors that in the books of my client, your balance is 3 lakh rupees, kindly confirm. So whether he agrees with this or not, he has to reply. Positive confirmation request asks the third party to reply to the auditor in all cases, either by indicating agreement or disagreement. So the debtor will have to reply. However, negative confirmation request, the confirming party is only going to reply if he doesn't agree with the information which I have mentioned in the confirmation request. So for example, I said in the books of my client, your balance is 3 lakhs. Please respond if you don't agree to this. So he is only going to reply if he doesn't agree to this, right? And if he doesn't reply, that means he has agreed to it. So what is negative confirmation request? Negative confirmation request ask the third party to respond directly to the auditor only when there is a disagreement with the information provided in the request. So if he doesn't agree with the information that I have provided, basically he will respond. Okay, now guys, try and understand that positive confirmation request is going to give you more persuasive evidence. Negative confirmation request kind of provides you less persuasive evidence than positive confirmation, because sometimes what may happen. um, let's say I have sent a negative confirmation request, and I was waiting for the reply, and the reply did not come. So I would assume that, yeah, he has agreed. But what if he never opened the letter? What if it was never delivered to him? So negative confirmation request is going to give us less level of assurance, guys. So, and I'm not saying that you shouldn't be using it, but in case you wish to go for negative confirmation request, okay, uh, you have to meet all the five conditions. When all the five conditions are met, then only you can go for a negative confirmation request. Else we would always prefer to send positive confirmation request. So in what cases can we send a negative confirmation request? Let us go through this point, guys. Okay, it says you are going to send a negative confirmation request when the risk of material misstatement is low. When ROMS is low, of course, when you feel that the ROMS is high, you can't take the risk of sending NCR. You would want to get persuasive evidence, so you would always be sending positive confirmation request, so that the recipient, the third party, the confirming party, at least replies. He has to reply. If you send a PCR, positive confirmation request, he has to reply in both the cases, whether he agrees or disagrees. So the kind of evidence that you are going to get is going to be more persuasive here, right? Okay. Second, guys, you're going to send negative confirmation request when the internal controls are effective. Okay. And these five conditions, all five conditions should be met. Then only we are going to send negative confirmation request. Okay. Third is population of items subject to negative confirmation request comprises of large number. So let's say we are checking the debtor balance. We have a lot of debtors. So the population of debtors comprises of lot of debtors. Okay. But then the amount is small. It says population of items subject to negative confirmation request comprises of large number of small account balances, transactions, or conditions. Okay, so it's large in number but the amount is small. Then low exception rate is expected. Now what is exception rate? Again, if you see, I think I have it here in the definition. Low exception rate is expected. What is exception rate? Exception means a response indicating disagreement. So you have no reasons as such to believe, guys, that the confirming party would not agree to this. You are expecting a low exception rate. Okay, then only you are going to use negative confirmation request. And finally, the auditor has no reasons to believe that my my confirmation request would be disregarded, that the confirming party would not give necessary heed to the confirmation request. It says the auditor has no reasons to believe that the recipient may disregard the request. When all the five conditions are met, then only, guys, you are going to send a negative confirmation request. Else, always prefer sending positive confirmation request. Okay, all right. Now, guys, there's one more definition that I have to teach you. Non-response. Now it is very simple. What is non-response? A failure of the confirming party to respond or fully respond to a positive confirmation request. So I had sent a PCR, but they have not responded, they have not replied. So it's a case of non-response. Or I send them a letter of confirmation, but it has returned to our office, it has returned undelivered. It has, maybe the address was wrong, or maybe the office was locked or closed, so it has come back to our office. It's a case of what? Non-response. Okay, so done. We are done with the definitions, guys. We have covered what is the meaning of external confirmation. We have covered what is PCR, what is NCR, what is non-response, what is exception. We have also covered what is the external confirmation procedure. Okay, now, guys, I told you this. See, point number three, I told you that you have to design the confirmation request. Now you have to basically learn two things from this part. What are the types of confirmation request? I've already told you that they can be positive confirmation or negative confirmation request. Now the thing is, when you're designing the confirmation request, what are the factors to be considered while you design an external confirmation request? What are the factors that you have to consider? Again, there are 7 points. So when you're designing the confirmation request, these 7 points have to be considered. What are the assertions that you are testing? Okay, now for example, guys, with respect to debtor balance, when I send an external confirmation request to a debtor, I am more concerned with the valuation, right, with the outstanding balance. So we have to see what assertion we are trying to test, number one, while you are making a confirmation request. So the assertion that you are trying to test, the level of risk of material misstatement. Okay, third is layout and presentation of the confirmation request, how you are going to present it, whether it is going to be, let's say, in soft copy, are you sending an email, or you're going to send hard copy. Okay, and prior experience on the audit or similar engagements. So of course, guys, when you're designing a confirmation request, to whom to send and what to write in the confirmation request, your experience would also matter here. Okay, we have already read about this method of communication, whether it is going to be in hard copy, paper form, or electronic medium. Okay, now one very important thing, guys, that you have to understand. See, when we send a confirmation request, it has to be through the management, and you also have to see whether management is actually asking the confirming party to respond or not, because confirming party will only be comfortable to respond to a third party. I'm the auditor, right? So for him, I'm a third party. So the confirming party, that particular debtor of this client, would only be able to confirm to me when the client, when the management of the company, they convince him that, sir, our auditor might send you a confirmation request. Kindly cooperate. Please respond to it. It's a part of our audit procedure. So if management tells them that you have to respond, they would be perhaps prompt in replying. Else, they might not be very comfortable in sharing things with a third party. I'm just a third party for them, right? So please understand, management's authorization or encouragement to the confirming parties to respond to the auditor. We have to see whether management encourages the third parties, the confirming parties, to respond to the auditor. And guys, we also have to see this, the ability of the intended confirming party to confirm or provide the requested information. Now, I know this debtor is a very small debtor, is a very small shop owner, let's say, and he doesn't even have computers and all. I know he maintains his accounts manually, and now I'm asking him very specific data on this data at this point of time. What was the account balance? Let us know and all. Just a hypothetical example. So he won't be able to reply, right? He maintains only accounts manually, and he, all the sales figure, whatever he has done, he will just put one figure towards the end of the month. This is how he keeps his account. So then in that case, you know um, asking him for a very specific detail would not be perhaps a good idea. So when you are making a confirmation request, you also have to consider whether the intended party will be able to provide you with such information or not. Okay, so this can be again an important question, guys. Factors to be considered while designing external confirmation request. In my regular lectures, perhaps I always tell, right, all the questions pertaining to factors are important. In some of my batches, I even make the students write all the topics of factors, basically factors to be considered in determining whether evidence is sufficient, appropriate factors to be considered for this, that, factors to be considered, I mean considerations for, let's say, determining whether a risk is a significant risk or not, factors whether this one, whether when designing external confirmation request. So all the list of factors, I make them write it separately so that they don't get confused. Okay, however, so these are 7 factors, guys, with respect to designing of the confirmation request. Okay, now sometimes management might refuse to allow the auditor to send a confirmation request. Okay, I have told you this, guys, we are not going to do the communication with the third party, with the confirming party secretly. It always has to be rooted to the management. But in certain cases, in some instances, it might happen that the management has refused to send the confirmation request. I mean, they have asked the auditor not to send the confirmation request. In that case, what has to be done? So number one thing, guys, the auditor shall inquire as to the management the reasons for refusal. You have to understand why management is refusing, and you have to see whether the reasons is valid or not, and then you have to evaluate the implication of management's refusal on the auditor's assessment of relevant risk of material misstatement. That means what? Hey, management is asking me not to go with an external confirmation. Is there something wrong? Maybe the risk of material misstatement for with respect to this debtor, is it high? The management doesn't want me to know about it. So you might have to evaluate the implication on the risk of material misstatement, and then you will have to perform some alternative audit procedures also, so that you obtain evidence. But then even after performing alternative audit procedures, let's say you are unable to obtain audit evidence, in that case, of course, we'll have to modify our opinion. Okay, now one thing I would want to just discuss, guys. Let's say management told us, sir, please don't send a confirmation request to them. And I asked, why shouldn't I be sending? So management tells us, sir, actually, we are having a dispute. We are having a case against that debtor. Okay, we say that the debtor owes us, let's say, we are supposed to get 2 crore rupees from that debtor, but the debtor is of the view that only 1 crore has to be paid. Okay, so the case is going on again in the court, and now if you do an external confirmation with that debtor, okay, they will have a point that, hey, this company doesn't, the auditor of the company, they don't even know their the amount which is outstanding, and they are fighting for a case for 2 crore rupees, and they are asking us what is the balance, and they might keep this as an evidence to be produced in the court of law, and we might lose the case. So this seems, as an auditor, yeah, this seems to be a justifiable reason, I mean logical reason. So in that case, I would not go with an external confirmation request, but rather I would have to perform alternative audit procedures. However, upon performing alternative audit procedures also. See the point. If the auditor concludes that management's refusal to allow the auditor to send a confirmation request is unreasonable, or let's say the auditor is unable to obtain relevant and reliable audit evidence from alternative audit procedures, then in this case, the auditor shall communicate with TCWG and he might have to express a modified opinion in accordance with 705, SS 705. Okay. All right. Now, analysis of the results of external confirmation. Now, sometimes, let's say we have got the external confirmation, we have got the response to the external confirmation. So you will analyze it, right? If a debtor has responded, you are going to analyze it. So there's a topic analysis of the result of external confirmation. Now, if the auditor has doubts about the reliability of responses, if the auditor has doubts about the reliability of responses, he shall obtain further evidences to resolve the doubts. So if say I'm not very convinced or satisfied with the kind of response that a particular debtor has given, so I might have to ask further questions to resolve the doubts. In the case of non-response, let's say what is non-response? I did tell you this. Let me just take you back to the definition. What is non-response, guys? A failure of confirming party to respond. Let's say the confirming party, we had sent them a positive confirmation request, but they have not responded. Okay. So yeah, in case of each non-response, the auditor shall perform alternative audit procedures, okay, to obtain relevant and reliable audit evidence. And when a response to a PCR is necessary, and alternative audit procedures, and let's say you have not got the reply and you performed alternative audit procedures also, but then still you have not been able to achieve or obtain the required evidence, then the auditor shall express what kind of opinion? Modified opinion. You might have to qualify or maybe give a disclaimer. Okay. So yes, with this, guys, the entire topic of external confirmation 505 is also over, and it's again a very pretty small standard, and we did a very quick revision. Hope you all are clear with the concepts. Okay. All right. Now going back to the master chart. Yeah. Going back to the master chart, if you see, so we have covered, guys, three standards already from the 500 series. We have covered 500, 501, 505, right? Now let us quickly move on to the next standard, which is again also a very small standard on 510. SA 510. Okay, what is 510 about, guys? 510 is about initial audit engagements. Okay, and in initial audit engagements also, we are going to look in for the opening balances. Okay, now first thing that you have to learn in this particular standard is that what is the meaning, guys, of initial audit engagement. Okay, let's first understand initial audit engagement. So initial audit engagement means an engagement where financial statements for the prior period, financial statements of last year, let's say of prior period, were either not audited. So let's say last year there was no audit, and now I happen to be the auditor of the company for this year, so it's going to be a case of initial audit engagement for me. Or they had an audit last year, but it was done by some other CA firm. It was audited by a predecessor auditor. So it's going to be an initial audit engagement for me. Again, I'm repeating this. What is initial audit engagement? I have got an audit. I have accepted your audit. But let's say in your company last year, there was no audit. Or if there was an audit, it was done by some other CA firm. So for me in this year, it's going to be initial audit engagements. Okay. Now, guys, the entire standard, you have to understand it in the form of a story that, okay, guys, if I am doing your audit, this is the first time I'm doing your audit. So, and last year there was no audit done, or last year some other auditor had done the audit. So the question that arises now is, last year's closing balances will be, I mean, you'll bring it forward, it will be opening balances of the current year. And if let's say last year there was no audit done, you are the auditor of the current year. So how will you verify whether the opening balances are okay or not? Are you going to again do the audit of the previous year? So this standard tells us basically about the procedures that we have to perform to obtain evidence about opening balances, whether the opening balances contain misstatement, whether the opening balances, the accounting policies with respect to opening balances are consistent or okay. So this is what we have to learn here. All right. So what is opening balance? Very simple, guys. Opening balance means account balances at the start of the period. And where do they come from? They are basically what they are, the closing balances of the prior period. You just bring it down, right? So account balances at the start of the period, and it is derived from the closing balances of the prior period. Okay, now account, when I say opening balances, it is not just the values, guys. Always remember, opening balances doesn't just means the transactions and events, it also would mean the accounting policies also. So it says it reflects effects of prior period transactions and events. So yeah, no doubt we are going to consider the transactions and events, but at the same time, the accounting policies also, application of accounting policies from the prior period. So there has to be consistency in the application of accounting policy. Okay, so this is what is meant by opening balance. And I told you this guys, that what is initial audit engagement, wherein the financial statements of the prior period were either not audited or it was audited by some predecessor auditor. So who is a predecessor auditor? Predecessor auditor will be a different CA firm, CA from a different CA firm, right? Auditor from a different firm. He can't be your partner, I mean partner belonging to the same firm. No, the firm has to change, right? So it says auditor from a different firm, and audit who has audited the entities, who has audited this company's financial statement in the prior period, and now he has been replaced by me, who has been replaced by the current auditor. I'm the current auditor. Okay, I hope this is clear, guys. The meaning of predecessor auditor. Okay, now just one thing I would want to discuss here. Probably you should. I hope you would be knowing about this. That guys, let's say this is year one. Okay, year two, and we have year three. Okay, year one. Let's say there was no audit, and in year two they have appointed me as the auditor to do the audit of the financial statements. So who is the auditor? Let's say the name of the CA firm is X and company. So for X and company, in this year two, is it a case of initial audit engagement? So yes, 510 would be applicable. It's a case of initial audit engagements. Now in year three, they were happy with the services of X and company, so they have asked X and company to continue as the auditor. So you only tell me, guys, will SA 510 be applicable in year three? What do you think? Yes, no, Amrita, you are correct. So here 510 will not be applicable. 510 is initial audit engagement. So this is the case of initial audit engagements. And here you would be concerned about the opening balances. Why? Because last year there was no audit done, or let's say last year some other auditor had done it. So will you blindly trust that opening balance of the current year? So you'll be worried. But then this year you have done the audit, right? So in the next year you would not be worried at all about the closing balances of the last year, which happens to be the opening balance of the year three. You'll not be worried because you only have checked it, right? You'll have some confidence, right? So here in year three, SA 510 will not be applicable. Okay, anyways, I hope it is clear. So let's quickly go through the requirements, guys, okay, of SA 510. What are the requirements of SA 510? Yeah, so we'll learn about the audit procedures with respect to opening balances first. Audit procedures, opening balances. Okay. So with respect to opening balances, what should be the audit procedures? Okay. In case of initial audit engagement, very simple. So you have to obtain sufficient appropriate audit evidence about opening balances. Okay. How are you going to obtain sufficient and appropriate evidence, guys? By confirming accuracy of prior periods closing balance brought forward. So you have to just see whether the closing balances of the last year have been properly brought forward in the current year or not. And it's not just about the figures, guys. It's not just about bringing the values correctly. You also have to ensure whether accounting policies are also correctly, appropriately reflected. So ensure opening balances reflect the accounting policies also. Okay. So what are the 2 points which I have just told you, guys? How are you going to obtain uh, sufficient in appropriate audit evidence with respect to opening balance? Number one, see whether the opening balances of the current year has been correctly brought forward, okay, from the last year. And it's not just about the values and the figures. We also have to see whether there is consistency in the accounting policies, whether the opening balance reflect the appropriate accounting policies also. And third is basically we have to perform some more audit procedures. Like what audit procedures? Review the prior year's audited financial statement. You can yourself, if we have the audited financial statement, you can go through the audited financial statement. Let's say last year it was audited by some other auditor, predecessor auditor. You can review the financial statements. Then very, very important 2 points. Assess, guys, if current period's procedure if you're doing something in the current year, if current period's procedure provide relevant evidence. So let's say guys, we are checking the cash payments of this year. I'm the auditor of the current year. I'm checking the cash payments, and I see that, oh, 3 lakh rupees has been paid to a person called as Mr. A in the month of April. Around 20th of April, 3 lakh rupees was paid. And then I see the closing balances of the last year. Oh, there is a debtor of 3 lakh rupees. So what has happened? It has helped me to confirm that yes, maybe there was a debtor and to whom the maybe there was a creditor A to whom the payment has to be made and the company has made it. So my intention here was I am doing the audit of transactions in the current year, but this has given me an idea about the opening balances. And you can sometimes you can specifically apply procedures to get the opening balances. For example guys, it says conducting specific audit procedures to obtain evidence about opening balances. It says conducting specific audit procedure. What does it mean when I say conducting specific audit procedure? It simply means that let's say you do the audit of the purchases, you have the sales, and you know about the closing stock now because it's a current year. So from this you are going to do the reverse calculation and go to the opening balance. And so we have done this on purpose to arrive at the opening balance to see whether it is correct or right. So these are certain procedures. Okay, very important question. The only important question which I feel which can be asked from this standard is this one: how will you obtain, what procedures are you going to apply for opening balances if it is an initial audit engagement? So number one, you have to see whether it is correctly brought forward or not. Second, you'll have to be concerned about the accounting policies also. Third, you might apply certain procedures, like you might review the audited financial statements. Okay, you might also apply some probably apply some current year procedures, and it might give you an idea about the opening balances. Or specifically you might apply specific audit procedures to obtain evidences about opening balances. Okay, now after doing this guys, if you feel that if any misstatements are detected, you are going to do additional audit procedures. And if you feel that there is misstatement in the current period, you have to communicate the same as per 450. 450 we are going to do it later on. We have it in our chapter number 7, so we are going to do it later on. Okay, all right. So this was guys with respect to the audit procedures of opening balance. But at the same time, you also have to see whether the accounting policies have been consistently applied. So evaluation of consistency of accounting policies. So as an auditor guys, we have to obtain sufficient appropriate evidence on what, on consistent application of accounting policies in current financial statement. So we also have to see that, okay, let's say they were valuing their stock as per weighted average last year, so this year also whether they are following weighted average or not. And guys, it's not that they can't change the accounting policy, right? The management, the company can very well change the accounting policy, but then in that case we have to ensure that when whatever change they have made, it's properly disclosed. So proper accounting for and disclosure of changes, of policy changes. So whenever they make any changes in their accounting policy, it has to be properly disclosed. Okay, and the third one is guys about the predecessor auditors report. So I told you, you are going to, let's say, go through the predecessor auditors report. Right now in this one, let's say if the predecessor auditor had given a modified opinion, will you not be curious to know, hey, why did he modify the opinion? Will you not go through the basis for modification paragraph? I mean, will you not read that paragraph as to what made the previous auditor, predecessor auditor, qualify the opinion or give a modified opinion? So let's say they mentioned that the company is valuing the stock at LIFO method, which is not in accordance with the accounting standards, let's say. So will you not immediately see that aspect in the current year also? Oh, this year also is the company maintaining the stock on LIFO basis? If yes, what is it that you are going to do? You are the current auditor. Will you not modify the current year's opinion also? Yes, right. So it says predecessor auditor's report means what? If the prior period's financial statements audited by predecessor auditor with it had a modification, it had a modified opinion, then what is it that you have to do? You will have to evaluate the impact of modification on the current period's financial statement also. Okay, oh, let's say you have to see the reasons. If you feel that, yeah, in current year also the inventory, they're still valuing it as LIFO basis, it is a risk of metal misstatement, it is a misstatement, so you'll have to modify your opinion. Okay, all right. So these are the things guys with respect to requirements. And I feel very the first requirement, which is basically about audit procedures for opening balances, is very important. Okay, now we are towards the end of the standard, guys. What about the reporting part? We are going to learn about audit conclusion and reporting. Very simple again. Okay, so when I talk about audit conclusion and reporting, let's talk about sorry, the opening balances first. Okay, what is the opening balance? What is it that you have to understand? See the points, guys. If you are unable, if you are unable to obtain sufficient appropriate evidence on opening balances, then what is it that you are going to do if you are unable to obtain sufficient and appropriate audit evidence? So in this case, guys, you have to either give a qualified opinion, or you might have to give a disclaimer of opinion as per 705. Okay, but if you are certain that yes, the opening balances contains misstatement, then what kind of opinion are you going to express? If there are misstatements, of course you are going to express qualified opinion, but let's say if the misstatements are pervasive in nature, you might even want to qualify your opinion. It says if the misstatement affects the current year's financial statement, so you will have to express qualified opinion or adverse opinion as per SS 705. Okay, now let's talk about the consistency of accounting policies. You are going to express a qualified or adverse opinion if current period's policy are not consistently applied to the opening balances. That means there is inconsistency in the accounting policy, and if let's say they have changed the accounting policy, guys, which is allowed, but then they have not made adequate disclosures about the same, so in that case you will have to express qualified or adverse opinion. Okay, and next one is, guys, let's say if there was modification in the predecessor auditor's report. If there was modification, so same thing, I've already told you this. If there was modification in the predecessor auditor's report, you would still want to see whether the reason for modification is there in the current year also, and if the same persists in the current year as well, you are going to modify the current year opinion also. Okay, so it says modify opinion on the current year financial statement if the predecessor auditor's opinion regarding the prior period financial statements included a modification to the auditor's opinion that remains relevant and material to the current period's financial statement. So if the reason why the predecessor auditor gave a modified opinion, if it still persists in the current year also, it is impacting the current year financial statements, then you shall be issuing a modified opinion in the current year as well. Okay, all right, yes. So with this, again, a very small standard, a good standard of SA 510 is over. We have completed the entire standard. Now going back to the main chart, guys, see, we have very quickly, out of the 8 standards which we have to cover in this particular chapter, we have already covered 4 standards. All right, guys, let us now start with SA 520, which is basically on analytical procedures. So let me just dive into this standard 520. Now, 520, yeah, we are going to learn about analytical procedure, and there are some other miscellaneous topics also with respect to 520. Okay, now all of you should recall this, that analytical procedures is one of the methods to obtain audit evidence. Okay, now what happens is, guys, in very layman's terms, if I tell you, sometimes only by doing test of details, let's say you check all the underlying documents, you do the vouching and all, it might just help you to see whether the information, whether the expenditure is correct or not. Let's say advertisement expenses of 3 lakhs, you do all the vouching and all, but then it will not give you a good insight. However, let's say advertisement expense of 3 lakhs, you compare it with last year, it is going to give you a good insight. Okay, let's say it's almost the same, or if there is a huge fluctuation, you would want to know the reasons also for the same. But let's say the company has made some fake advertisement expenses of 3 lakh rupees, and they have produced some documents also. Okay, but then you will not be able to understand the logic if you only do TOD. However, if you are smart, if you do analytical procedures, you can question the management immediately. Hey, what is the reason? Last year there was no advertisement expense, this year we have incurred this much. So then they might give you explanation, and you would basically try and understand. So remember, analytical procedure is like more of a intelligent procedure. Okay, now what is meant by this? We have to understand these topics, guys. We are first going to understand the meaning of analytical procedure. Okay, I'm going to come to the objective of 520 later on, but then first we are going to discuss the meaning of analytical procedure. Then we are going to discuss about the nature, purpose, and few requirements of SA 520. Okay, so first things first, guys, what is the meaning of analytical procedure? Okay, it means, it says that evaluation of financial information When I say analytical procedure, what does it mean, guys? Analytical procedure means evaluation of financial information made by plausible relationship among both financial and non-financial data. So we are evaluating the financial information here by analyzing both financial as well as non-financial data. Now what does this mean, guys? Try and understand it in this manner. Yeah. So I can understand the financial information by analyzing only financial data. For example, when I say GP ratio, now GP ratio is calculation based on the financial data only, right? We'll take the uh, elements of the financial statement. But then let's say, guys, if I want to see what is the uh, average salary which is paid to an employee. Okay, so here probably what is it that I have to do? I have to see the employee benefit expenses, and I have to ask them, how many employees do you have? Now this number of employees is a non-financial data, but it is going to give me a good insight. Okay, last year the average employee cost was this year it has become this. I can do a comparison, but then I have considered something which is non-financial in nature. So remember, guys, when I talk about analytical procedures, okay, it may involve evaluation of financial information by understanding plausible relationship between among both financial and non-financial data. Evaluation of financial information made by plausible relationship, it should be among both financial and non-financial data. Okay, now again, if I put try and make you understand what is the meaning of the word plausible relation. Sir, analytical procedure means ratios, comparisons, etc., but it doesn't mean that you're going to calculate any random ratio. I mean, maybe let's say legal expenses to sales, they have got no connection. So if you find unnecessary, you calculate legal expenses upon sales and then you say I've done a ratio analysis, it is going to be of no use, guys. Okay, there has to be some plausible relationship. For example, if I say GST upon sales, yeah, still there is a relation, so makes sense to do such a comparison, right? So when I say analytical procedure, guys, remember it is evaluation of financial information which is made by plausible relationship among both financial and non-financial data. Again, let me tell you guys, this is just a revision session, right? But in my regular lectures, I mean, we cover this in a very practical manner, right? See, what is analytical procedure? I even start this with the example that you can compare the last year expenses to this year, and when you do a comparison, it is a part of analytical procedure. And then if you feel that the expense in one area is very high, you would of course ask the management for the reason, understand the reasons, and accordingly do your procedure. So remember, guys, what happens is this analytical procedure is more of an intelligent procedure. Sometimes test of details alone might not give you good insights, but analytical procedure might do. Okay, now okay, now one more aspect of analytical procedure which you all have to understand is analytical procedure doesn't mean only just that you have to calculate ratios and do comparisons and all. When you actually calculate ratios, when you make comparisons, when there is huge fluctuation, you have to investigate for the identified fluctuation. You have to ask them the reasons. Why is traveling expenditure so high this year as compared to last year? So you have to identify, you have to investigate the identified fluctuation also. This is also part of analytical procedure. Okay, I hope this is clear. Now, when I say, guys, about the nature of analytical procedure, all of you already know this. Either we can go for comparisons. When I say comparison can be with respect to the figures of the previous year, comparable information for prior periods. It can be comparison with the anticipated results. Let's say actual versus budgets. We had made certain budgets, so we can compare the actuals with the budgets. We can compare with similar industry information also. We can compare the client's data with that of the competitor, with that of the industry data. Let's say the GP ratio in this industry is this much, so we can compare the GP ratio of our client with that of the industry data. So these are comparisons. And when I say relationships, guys, relationships again in layman's terms means ratios. Okay, so ratios can be among elements of financial information. Like for example, GP ratio, it's between the elements of financial information. Okay, and then it can be between financial and non-relevant non-financial information too. Now the example which I gave you, I want to see average salary expense. So total salary expense upon number of employees. Let's say I want to see, it's a hotel, I want to see the average room tariff, let's say. Okay, so total tariff divided by occupancy rate, number of rooms, etc. You all know this, right? So we take non-financial information also into consideration, right? Now, we have covered two things. We have covered the meaning and we have covered the nature of analytical procedures. Okay, now the point is, guys, when is it that we have to do analytical procedures? Now understand it in very simple terms, practical terms, guys. When you go for audits after your C intermediate exams, let's say you go for audit, the first thing probably your principal would want you to do is they'll give you the balance sheet of the entity and they would want you to calculate important ratios, and they will ask you to compare it with the last year. Why? I mean, will they ask you to do it before you start the audit? They would want to know what are the areas that they have to focus more in the current period's audit. So they'll compare the ratios they'll with the previous years, and if there is huge fluctuation, they are going to put more emphasis on those areas in the current period audit. Okay, so remember that we do analytical procedures even before we actually start the audit. And then it may also happen that when we are doing the audit also, let's say now I'm doing test of details, sorry, I'm doing substantive procedures, then also I can do analytical procedures. And one more thing, one more area, towards the end of the audit, when you are just about to sign your audit report, then also you will do an analytical procedure. You will again calculate the important ratios to see whether the ratios are in alignment with your understanding about the entity. Okay, so let's say you know that GP ratio of this industry is this much. So just before signing the audit report, you would again want to reconfirm whether the financials are correct or not. You would want to calculate the important ratios and see whether it is in conformity with your understanding about the entity. So when I say purpose, guys, please remember analytical process can be performed as a part of, it's about the timing. So you do it at the initial stage as a RAP to obtain understanding of the entity and its environment. So when the example I told you that once you go in your first audits, let's say as an article, your principal might ask you to calculate important ratios. Why? It's a part of RAP, because I know that if there is huge fluctuation, there might be misstatements, and I accordingly I'm going to focus more in those areas during the actual audit. So as a part of RAP also you can use analytical procedure. Then as substantive procedures you may use. And third is as an overall review of the financial statement as at the end of the audit. Just before signing the audit report, you are going to do an overall review of the financial statements. Okay. Now, guys, very important point for you to understand. Okay. I told you this, and let me just again take you back to SA 315. In SA 315, I taught you about RAP. And there we learned that as a part of RAP, what all procedures can you apply? You can do inspection, observation, inquiry, and we covered analytical procedures there also. Okay. So I hope you're clear that analytical procedures can be done at the planning stage, at the actual audit testing phase, and also at the reporting stage. Just before the reporting part also, towards the completion stage, you might also go for analytical procedure. In my regular classes, I always use this analogy that, guys, that you can compare analytical procedure. Let's say you are unwell and you go to a doctor. Okay, so without prescribing you the medicines, I mean, before even he prescribes you the medicines, he would want to probably get a ratio analysis done of your body. I mean, whether the vitals in your body are okay or not. So before he can proceed with some procedures or prescribe you any medicine, he would want you to go to a diagnostic center and get some tests done. So this is a part of, let's say, RAP. On the basis of your body count, body analysis, let's say, okay, or the various blood counts and whatever you have, okay, or the you know the actuals, and we have the reference values also. He's going to give you the medicines, right? So let's say he's applying substantive procedures, and then let's say you take the medicines for 7 days, 5 days, and then you happen to basically, let's say, feel a bit better. Then you ask the doctor, can I stop the medicines? Doctor says, wait, let's do a body analysis again, and then he will see your vitals again, and then he will decide that when to stop the medicine, or should you be continuing it for further 6 7 days. So please remember that analytical procedures can be done as a part of RAP, as substantive procedures, and also towards the end of the audit in the completion stage. But please be attentive, guys. What I'm trying to tell you next is very important. Please understand that SF 520, no doubt analytical procedures can be done at 3 stages, but SA 520 only focuses on analytical procedure which is done as substantive procedures, and analytical procedure which is done at the end of the towards the end of the audit. But this analytical procedure is covered in 315. It is a part of 315. I told you about RAP. RAP is covered in 315. Okay. Hence, keeping this in mind, now read the objective of this standard. This objective probably will give you an idea. It says to obtain relevant and reliable audit evidence when using substantive audit procedure, and to design and perform analytical procedure near the end of the audit that would assist the auditor when forming an overall conclusion as to whether the financial statements are consistent with auditors' understanding of the entity. So you won't see the RAP part here. SA 520 only deals with analytical procedures which is performed as a part of substantive audit procedures, and one which is performed towards the end of the audit, let's say in the completion stage. Okay, sir, analytical procedure, is it not done in RAP as an RAP? Yes, it is done, but that is taken care by SA 315. I hope you are all clear with this. Okay, all right. So we have covered the purpose also. Now let's understand the main standard, guys. We are going to learn about the requirements of analytical procedure SA 520. Okay, so we have just 3 points to cover, guys. If you can see on the screen, we have just 3 requirements. Use When will you use analytical procedure, or what are the conditions of using analytical procedure as substantive analytical procedure? And I told you when how to use analytical procedure towards the end of the audit. I mean, when you are towards the completion stage. And finally, did I not tell you this? In the definition of analytical procedures, I told you that analytical procedures encompass the investigations also. So third is investigating the results of analytical procedures. So these are the 3 things that we have to cover. Okay, let's quickly go through them, guys. So the most important part of the entire standard is this one: use of analytical procedures as substantive analytical procedure. Okay, so the question comes is basically the auditor shall, you know, when you are using analytical procedures as substantive analytical procedures, you have to consider these aspects. Number one, you have to determine whether doing analytical procedure here would be suitable or not. So first thing is you'll have to check upon the suitability, whether it is going to be suitable here to do analytical procedures. Number one. Second, when you're doing an analytical procedure, guys, you also have to be concerned about the reliability of the data from which auditors' expectation is developed. Now, what happens is, guys, see, when I'm doing an analytical procedure, I would also develop an expectation. Expectation means what? That, okay, GP ratio must be this much. And then I'll compare it with the actuals. If there is a huge deviation, what is going to happen? I will have to do more of test of details. I'll inquire of the management. I'll obtain, other evidences. Okay. So the very important thing is, guys, when you develop this expectation, let's say with respect to GP ratio, it can't be a random expectation. Oh, let's assume the GP ratio is 10%. No, I mean, this expectation that you develop has to be as much as possible, very much close to the actuals. It must be very much precise. Okay. And for that, it would be precise, of course, when you have to see the reliability of data from which auditor's expectation is developed. The more reliable the data is, the more precise your expectation would be, and then you're going to develop an expectation which is sufficiently precise. After this, what is it that we have to do? We will now compare. It says determine the amount of differences of recorded amounts. Recorded means actual amount from the expectations that you have developed. Okay, that is acceptable without further investigation. That is acceptable without further investigation. So for example, you were expecting a GP of 10% and actuals has come from to 9.98. It's almost very close. You don't have to further investigate. But then all imagine this, that the GP ratio, you were expecting it to be 10%, the actuals it is 18%, way too high. Then you might have to investigate, let's say, because it is way, quite different from what you had expected. It is beyond our tolerable range. Okay, so what are the 4 things, guys? Number one, first you'll have to see whether the use of analytical procedures is going to be suitable in this case. Number one. Second, you will have to see the reliability of data. Okay, so that the expectation that you developed is also precise. And then whatever expectation you develop, guys, it can be random. It has to be very much sufficiently precise. And then, guys, you are going to compare the actuals, the recorded amount, with your expectations. Okay, and if it is within your tolerable range, okay, or let's say there is a difference, but it is within your tolerable range, you would not want to further investigation. But then if the difference is huge, you would want to go with further uh, investigation. Okay, now I told you the standard is, guys, going to revolve around this point majorly. I have marked it as important also. So what factors will help you to check whether doing analytical procedures here would be suitable or not? So with respect to suitability, we have few factors to keep in mind, guys. We have 5 factors to understand. So number one, if the volume of transactions is very high, volume of transaction is very high, you might resort to doing analytical procedures. But let's say there are only one or two transactions, there, what analytical procedures will we do? It's better to do test of details then, right? So number one factor whether it is going to be suitable to do analytical procedure is basically volume of transaction, guys. Again, whenever you do analytical procedures, you have to see whether there is a predictable relationship. I mean, let's say comparing GST upon sales, somehow you can predict, right? GST is, let's say, a percentage of the sales amount, so it's predictable. But you just can't predict legal expenses to sales. Okay, so if there is some predictable relationship, then only you are going to go with the ratios analytical procedure. Okay, third is basically level of assurance. What kind of level of assurance you are getting? If you are getting high level of assurance from doing analytical procedure, use analytical procedures only. But then if you are getting low level of assurance, you might have to combine analytical procedure with other procedures like test of details, like maybe you might have to go with an external confirmation as well. Okay, so the point says level of assurance. Okay, now for example, guys, I'll give you one simple example. Let's say there is rental. Okay, this company is earning rental income. I know that. Okay, I saw the agreement. I know that the rental income per month is 1 lakh rupee, and in their PNL it is coming as 12 lakhs. So I can just multiply 1 lakh into 12, it is coming 12 lakhs, fine. Do I need to do a test of detail here, check rent receives everything and all? No, not required, because here I'm getting a good level of assurance, right? But this might not be the case in all the aspects, right? I mean, if it's a discretionary expenses, you can't just go and do analytical procedure, you might have to do test of details. So what level of assurance you are getting also will help you to determine suitability of analytical procedure. Okay, now if the internal controls of over a process, if the internal controls are good in an organization, then you can go with analytical procedures. Why? Because internal controls are good, the reliability of data would be more. Okay, and then is other audit are, are you going to do other audit procedures? Can you do other audit procedures also? Let's say, guys, for example, if you do analytical procedures, you do the data turnover ratio, along with that you're also doing external confirmation, so all the way you're going to get more assurance here. Okay, so you have to also see whether other audit procedures are also possible to be done along. So all these factors you have to consider to determine the suitability of a substantive analytical procedure. Okay, now uh, next is basically how are you going to determine the reliability of data? So for reliability of data, guys, we have four simple points. Now, number one, what is the source of information? Okay, whether it is external or internal. Okay, second is basically comparability of the information available. I mean, see, a data would become more reliable if you can compare. Okay, in simple words, if I tell you this, let's say, guys, we are manufacturing this bottle. Okay, we are into manufacturing of this bottle, and I want to compare some of my data with the industry. But then the industry data which I have produces some plastic bottles. Let's say this is a plastic bottle. So it's not a good thing to compare this metal, thermal jars with the plastic water bottles, let's say. So here comparability is less. So the data is not reliable for me. Okay. I'm not saying that the data is wrong, but it is not going to be a good thing for comparison. So the more comparable the information is, the more reliable the data will be for you. Okay, now on the other hand, let's say I have the industry data which pertains to same bottles, then the data becomes reliable to me because there is comparability. Okay, next, nature and relevance of the information available. What type of information is available? Too much of information, if it is too complicated also, it's not a good thing. And whatever information, I'm talking about the reliability of information, right? So controls over the preparation of information, if the internal controls are good, then the reliability of data is going to be very high. Okay, so with respect to the reliability of data, guys, we have 4 points. Number one, source, comparability, the nature, and internal controls. So you have to remember the four factors to be considered to understand, to know about the reliability of the data. Now I told you, guys, you must have developed an expectation. Okay, before you do a ratio, you do a analytical procedure, you must have developed an expectation. Now this expectation has to be very much precise. Okay. So how are you, it says develop an expectation that is sufficiently precise. So what will make you develop an expectation which is actually very much close to the actuals? How can you develop an expectation which is going to be very near to the actuals, very close to the actuals, very much precise? So number one, it's basically accuracy with which expected results can be predicted. Accuracy with which the expected results can be predicted. What does it mean? Let's say, guys, the more plausible and predictable the relationships are, the more precise is going to be the expectation. Now for example, guys, let's say, can I put it in this way, that it's usually plausible to expect that an increase in sale, if there is an increment in sale, okay, my debtors would also increase. They are related, right? But is it necessary that if there is an increase in sale, the legal expenses is also going to go high? No. So what I'm trying to tell you is, the expectation you develop is going to be more precise when there is what, when the results can be predicted, when there is a plausible and predictable relationship, then your expectations are going to be more precise. Next, when there is disaggregation of information, guys, for example, let's say, uh, your company, okay, you are dealing in four products A, B, C, and D, and you give me a consolidated figure of the sales. In that case, making uh, expectations which is very precise might be a bit difficult. On the other hand, if you give me very specific data with respect to the four products, that for product A this was the sale, product B this was the sale, so you would be able to make more precise expectations with respect to each of the products. Okay, so what I'm trying to tell you is, the more disaggregated the information is, the more detailed the level at which an expectation is formed, the greater is the precision. So more disaggregated the information is, the, the more details you are given, the better will be your expectations. Okay. And also availability of information, again same thing, guys. When I say availability of information, let's say, if you have been given both financial and non-financial data, the expectation that you can develop will be better. For example, I want to know about sales. Sales is a financial data, but other than sales, they give me a lot of details. They give me the details of the number of orders they received, the number of quantities they have sold, the number of goods they have dispatched. They give me the dispatch details also. These are non-financial details, right? So if they give me all such information, it would be better, I would be able to develop an expectation which is going to be very much precise. Okay. And once this is done, guys, once this is done, we are going to determine the amount of difference of recorded amounts. Recorded is the actual. Okay, so determine the amount of difference of recorded amounts from the expected values that is acceptable without further investigation. So basically you have to define your tolerable range here. Okay, so if it falls within your tolerable range, you would not want to go for further investigation, but it is way beyond your tolerable range, you would want to go for uh, your further investigation. Now in very layman's terms, guys, what, I have not discussed, of course it's a fast track fast revision class, so in our regular lectures we discuss this very practically. Okay, but for the moment it is not going to be possible, but then you can understand this from this analogy. Let's say you are appearing for the exams. Okay, now what happens is, guys, you only tell me, I mean, you have MCQs as well as subjective portion. Where will you be able to develop a precise expectation that, okay, in MCQ portion I might score this much, and in subjective portion I'm going to score this much? You generally evaluate, right? After coming from the exam, we calculate, oh, this is the marks that I might get in MCQ, this is what I might get in subjective area. So where can you develop the expectation more precisely? Of course in the MCQ section. Why? Because if it is correct, you know that you're going to get full marks. But in subjective, even if it is correct, it totally depends. You are expecting 4, you might even get 2 out of 5, right? So you have to understand, guys, when is your expectation going to be more precise. But then let's say now the actual results comes, you are expecting 55 in one particular subject. Okay, and you got 54 or you got 56. Will you want to go for in further rechecking and all? No, because it is within the range. But then let's say you are expecting 55, but then you have only got 27. Of course you would be angry and you would go for what, further investigation. So it says determine the amount of difference of recorded means actuals from your expected values that is acceptable without further investigation. But then if it is beyond your tolerable range, of course you will have to, guys, investigate. Okay, but yeah, we are going to come to the investigation portion, don't worry. But then at the same time I have to tell you this also, that analytical procedures can be used, guys, has to be used at the near completion of audit towards the reporting phase also. So analytical procedures that assist when forming overall conclusion. It says the auditor shall design and perform analytical procedure near the end of audit that assist the auditors when forming an overall conclusion as to whether the financial statements are consistent with the auditor's understanding. So why would the auditor do analytical procedure towards the end? Just to gain an understanding whether the financial statements are consistent with auditors understanding of the entity. Okay, all right, now having understood these two parts, guys, this topic again, use of analytical procedure as substantive audit procedure, it is very very important. Okay, so you have to first see whether doing analytical procedure is going to be suitable or not. Second, you have to see whether the data which is going to be used is reliable. Third, you're going to develop an expectation which has to be very much precise. And the fourth one is you have to then see the difference between the actuals and your expectation. If it is beyond your tolerable range, you have to go for further investigation. Okay, now I just want you to have a look at this chart. Just let me just open. Yeah. See, generally, what we discuss this in regular class. Actually, practically, what happens is we first develop an expectation, and this expectation has to be really very precise, close as much as close uh, as possible to the actuals. And then, guys, we define a tolerable difference. That okay, if let's say I get 50, I am expecting 55, but then if I get 52 till 58 or 59, anyways, upper side will be happy only. So if I get let's say 52 till then I'm okay, but if I get below 50, that means the paper checker has made some mistake. Okay, so you would want to go for further information. So when you develop an expectation, then you define the tolerable difference, and then you compare the expectation with the recorded amount. Recorded amount means what? Actual amount. Now if this difference is the difference greater than the tolerable difference, if it is very, the fluctuation is very high, I mean what you were expecting and the actuals, it varies a lot, then you would want to investigate the difference. You would want to further investigate the difference. What is it that you are going to do? You are going to make inquiries and you are going to obtain further corroborative evidence. But then if the difference is not much, it is well within your tolerable range, you are going to accept the amount, you'll be happy with the amount. That's it. Okay, and guys, when the difference is too much, what is it that you do? You are going to make inquiries of the management, and then you are going to look in for other evidences also. Okay, now when you feel that the other evidences and explanation given to you by the management is fine, you are going to accept the amount. That's it. So this is practically guys what we do. And then we have in our regular lectures, we discuss it practically also using case. Okay, if you can see, we have a case here, but that is not required at the moment. We are just in our super fast revision series. Okay, so please remember, when are you going to use analytical procedure as substantive analytical procedure? Four things: suitability, reliability, expectation, and then we have to see the difference. If the difference is beyond the tolerable difference, it would warrant further investigation, right? Now, when I say investigation, what does it mean? So 520 requires auditors to identify fluctuations or relationships that are inconsistent with other relevant information, or that differ from the expected values by a significant amount. So when my expectations and the actuals differ a lot, okay, then probably I'll have to probe in, I'll have to investigate. Okay, and the auditor shall investigate by doing what I told you. Number one, I'm going to inquire the management. Of course, if the traveling expense of the current year varies a lot as compared to the previous year, I'm going to inquire the management. Hey, what is the reason why the traveling expenses has gone up so high? And I might also have to perform other procedures as necessary. Okay. All right. You have to obtain basically corroborative evidence. Done. So with this, guys, yeah, the SF 520 part is over. Again, I'm telling you that the major area is this one. You need to remember the factors for suitability. What factors would make the data, I mean, would contribute to the reliability of data. How can you develop an expectation which is sufficiently precise? So you have to remember the factors also. Okay, we have few more topics, I mean just miscellaneous topic with respect to analytical procedure, and here it's just the techniques that we have to cover. Okay, we have it in our ICA material. So what are the techniques of analytical procedures? So we have got few techniques. Auditors develop expectations. we develop expectations using a lot of techniques, right? So what techniques can we use? We have got four techniques, guys. We have trend analysis, we have ratio analysis, we have something called as reasonableness test, and we have structural modeling as well. So these are the four different types or techniques which the auditor will use to develop the expectations, and then he is going to compare the expectations, of course, with the actuals, right? So what is trend analysis? Very simple, guys. Trend analysis means analysis of changes over period of time. Okay, so if I'm comparing advertisement expense of this year to that of the previous year, it's a trend analysis. If I'm comparing a particular expenses in the month of March 2024 with the corresponding figure in the month of March 2023, again it's what, uh, uh, trend analysis. Okay, all right. So comparison of current balance with previous year balances, right? Next is ratio analysis. All of you know this, you are champions in financial management subject. So what is ratio analysis? Useful for analyzing assets and liability accounts as well as revenue and expense accounts. And ratios can be, again, so when you calculate all those ratios, right, debtor turnover, we have so many different ratios. But then again, what can happen, you can calculate ratios, great, but then you can compare the ratios with the previous year also, right? Again, it would become trend analysis. So it says ratios can be compared over time or to the ratios of separate entities. We can even compare our ratio, GP ratio, to that of the competitor. So you can either compare your ratios over a period of time, or it can be even compared to the outsiders. It says ratios of separate entities also, or other companies in the same industry, maybe your competitors as well. Okay, so guys, trend analysis and ratio analysis, I'm very sure everyone would be able to write. But then now, what is reasonableness test? Let's understand this. There are two more points: reasonableness test and structural modeling. Okay, so what is reasonable test? It involves forming an expectation using a model. Okay, we use model here. In structural modeling also we use model, but the analytical procedure does not rely on events of prior periods, but upon, please remember this, when I say reasonableness test, I am not looking into anything of the prior periods, but I am developing my expectation using, please mark this, non-financial data for the audit period under consideration. For example, occupancy rates. I'm considering the occupancy rates to estimate the rental income, or interest rate to estimate the interest income. So I'm just considering, I asked, what is your interest percentage? So they say, oh, we are getting 7%. Oh, I'll just see the amount they have invested, do the calculation, and yes, I'm there with the amount that this should be the interest. Okay, so I have not considered anything of the past year. However, I've taken some non-financial data into consideration to develop this expectation. Okay, so this is called as reasonableness test. Okay, now we have sorry, so we have one more point, guys: structural modeling. Now this also is somehow similar to reasonableness test. But remember, it involves use of statistical model to quantify the auditor's expectation about a financial statement or a ratio. We use statistical model. As an example, the auditors could develop an expectation about the client's sale for this year with a model that uses amount spent on advertising, the square footage of the selling space, let's say they are into real estate, and personal disposable income. I mean, the level of income of the people, basically. So I can use all this data, I can develop a model using statistics, which is going to give me the expected values. Okay, now please remember, guys, again, I'm telling you, trend analysis and ratio analysis is still easy, but then what may confuse you is reasonableness test and structural modeling. Remember, reasonableness test is based on non-statistical non-financial data. Okay, you don't consider anything of the past. However, structural modeling is based on statistical models. Okay, you consider expectations by a lot of things. Okay, one primary difference is basically what reasonableness test differs from structural modeling in that it is less formal and it is not based on statistical model. Reasonableness test is not based on statistical model. Okay, so these are certain techniques, guys, which the auditor might use to develop expectations. Okay, and with this, we are done, guys. We are done with the topic of analytical procedures. We have covered the standard. We were quick, we were fast, and but then we have covered everything with respect to SA 520. Okay, now coming back to the master chart, if you see, we have completed 500, 501, 505, 510, and also 520.